While taxes and inflation are inevitable for nearly every retiree, mitigating the effects of them are something that each and every retiree should be striving to do. In today's video, we want to cover how inflation actually will have an impact on the taxes that you'll owe in retirement. It can be a double-edged sword in some respects, but we want to make sure that inflation, while that can take away from the purchasing power of your dollar, it can also in some ways help with taxes, but hurt in other areas. Understanding the difference between the two and making sure that you have a plan to tackle both inflation and tax in retirement can allow you to enjoy more of the wealth that you've saved, risked, and earned over the years, and make sure that you're able to enjoy your best retirement. If we've not yet met, my name is Danny Sinowitz. I'm a CFP professional from Hyperion Financial, and we've created a quiz to help people better understand how taxes work in retirement. Check it out in the description below. So while inflation is objectively not a good thing because it takes away from the purchasing power of retirees, it can allow for cost of living adjustments, which can lower tax or at least keep tax level for several retirees as well. Let's first cover some of the things that are inflation adjusted. The first one, and it should be fairly obvious, are federal income tax brackets. These are both ordinary income tax brackets and capital gains tax brackets. These will tend to go up with inflation each and every single year. And you can see an example here from 2024 to 2025 of both ordinary income brackets and capital gains brackets. Along with that, the standard deduction generally will go up as well. That's indexed for inflation. So for retirees, as they're continuing to earn more dollars, whether it be from IRA withdrawals, pensions, Social Security, or investment proceeds, regardless of the different ways in which dollars are made in retirement, if the capital gains and the ordinary income brackets continue to go up along with the standard deduction, you could notice less tax that would be due, even though your income is going up. These adjustments are usually announced at the end of the prior tax year, so you can have an idea of how much you would see a bump up in the following year. Another thing that is also inflation adjusted are the estate tax limits, and this would include folks who pass away with a sizable estate. If you pass away with a sizable estate, it is protected up to a certain amount, and that amount is adjusted for inflation. As we talked about in prior videos, the Tax Cuts and Jobs Act is set to expire at the end of this year. There's been much of debate that has taken place, but some of these tax brackets, such as capital gains brackets and the ordinary income brackets, in addition to the estate tax limit, are all things that have been subject to debate. Assuming that this does continue to pass, you're likely to see that each of these things will continue to be adjusted for inflation. So directly, there shouldn't be more tax that would be owed in the event that any of these things would increase for retirees. Another thing that can be helpful for retirees that are still working are retirement account contributions. So between IRA, Roth IRA, or 401k contributions, for example, these, generally speaking, will go up. And again, they're oftentimes inflation adjusted. So if you have earned income or you have a 401k, 403b, etc. at work, this could be a way in which you're able to defer some income or put dollars into a Roth via a contribution. And when you're able to do this, it's able to help either put in a tax deferred or a tax-free vehicle. Now, while there are sure other examples of things that will adjust for inflation, and those might be the most common, there are three things that could affect retirees that haven't adjusted for inflation. The first one is net investment income tax. Now, we shot a video on net investment income tax of what exactly it is. So if you'd like more information, be sure to check out the link for that video. However, with net investment income tax, one thing that's important to understand is that if you go over a modified adjusted gross income of $250,000 as a married filing jointly couple or $200,000 as a single taxpayer, in the event that you go over that amount, you have other investment income, you would be subject to pay on the lesser of the two a 3.8% additional tax. But here's the catch. While this was first introduced in the mid-2010s, they've not adjusted those amounts for inflation. So while $250,000 or $200,000 could be considered a higher income earner over the next several years and over the past several years, as we've seen with inflation, the definition of higher income earner continues to go up, but those limits that we see will stay level. Another example of inflation and tax not necessarily being a good mix would be the SALT deduction cap. Back in 2017, the Tax Cuts and Jobs Act put a cap on the amount of state and local tax that would be paid that you could use. So if you live in a high tax state or have a high tax or local ordinance, you could utilize the state and local tax deduction in combination with other itemized deductions and potentially lower the amount of tax due. That being said, that $10,000 state and local tax deduction has not been adjusted for inflation, and that's including over the past 8 years. As we've talked about, though, there's been a lot of debate of the Tax Cuts and Jobs Act and the future of that, and the state and local tax deduction has been one of the most hotly debated topics, and the future of that is clearly uncertain. Now, it's not clear if there will be an inflation adjustment added to this, but if there's not, we could be looking at a similar situation. years down the road. Something else that hasn't been adjusted for inflation for quite some time now are capital loss limitations as well. While nobody wants to take a loss on any type of investment, sometimes losses do happen. And one of the silver linings of a capital loss is that you can deduct that against other types of income in a given year. So, for example, if you have a capital loss, you can deduct that against ordinary income, such as earned income, Social Security income, pension income, etc. The problem, though, is that it's limited to $3,000 per year. So, assuming you have a capital loss offset with a capital gain, that dollar amount isn't necessarily limited. But when it comes to offsetting against other ordinary income, that dollar amount is limited to $3,000. Therefore, if you have a capital loss that's significant and you want to deduct that against other ordinary income, you can only deduct up to $3,000. Keep in mind that this amount has not been adjusted for inflation since 1981. Now, there is at least a provision that you can carry forward that loss in future years, so you can utilize that loss for future years if you have other ordinary income. The problem, though, is that that $3,000 amount each and every single year continues to lose purchasing power. Now, one thing that I think a lot of people have questions on is Social Security, and for good reason. And when it comes to Social Security, there's kind of a combination between both good and bad when it comes to inflation and Social Security adjustments. So for retirees who are receiving a benefit, or even those who maybe not yet receiving a benefit, but continue to accrue service, there is a COLA adjustment, a cost of living adjustment that takes place each and every single year for retirees. Therefore, it's able to keep pace with inflation, at least to some degree. There's also the earnings limitation for those that are collecting prior to full retirement age, that you're able to earn an amount in a given year prior to your full retirement age and not have dollars withheld. If you earn too much in a given year, you will have those dollars withheld, and then they'll be repaid once you reach full retirement age. So understanding that this is inflation adjusted can also allow for retirees who are not yet ready to give up work entirely, but still want to collect early, a way in which you can earn a given amount without having any of your Social Security pay withheld. But when it comes to inflation and Social Security and the negatives that come about, the most obvious one would be Social Security tax. So when it comes to the taxation of Social Security benefits, it's going to be based on your provisional income, and those provisional income amounts are going to apply to thresholds depending if you're single or married filing jointly. Now, we've done several videos on concepts like this that cover taxation of Social Security benefits. So rather than getting into the details of it, I'll link to one right now that you can check out and make sure that you're able to find a better idea of how this works if you're curious. But when it comes to how inflation would work, these thresholds that I just mentioned are not indexed for inflation. As a matter of fact, they've not been indexed for inflation since the early 80s and the early 90s. As a result, these thresholds would have been considered higher income earners back in the 80s and 90s. Today, more and more retirees are able to achieve this amount, and therefore it would be far more of a middle class to even slightly below middle class of the amount that would be received in retirement. If these brackets are not adjusted further or indexed for inflation, I think it's fairly obvious to say that even more will continue to cross these thresholds, and more Social Security benefits could be subject to tax. So what can you do about this as a retiree? Well, the first thing that you want to do is get an inventory of where your sources of income are actually coming from. If you know where they're coming from, usually what you can then do is have an idea of A, how it's taxed, and B, how COLA adjustments would work. Again, for example, when it comes to Social Security, COLA adjustments do take place. When it comes to a pre-tax pension, depending on the pre-tax pension plan you have, you may or may not have a COLA adjustment that takes place with that. When it comes to 401k, retirement account withdrawals, or investment withdrawals, once again, they don't have a set amount that you necessarily would need to be taking from year to year. So you can look to take more or less, but that would also depend on your investment strategy. And equally importantly, the tax classification of your account would have an effect on your income and how that would be taxed in any given year. So making sure that you have an accounting for each of these, how they're taxed and how they would work with inflation, can be a way in which you can create a retirement income plan that's able to keep pace with inflation, minimize taxes, and still provide for the course of a 20, 30, 40-year retirement, however long it is that you're planning to be retired and live through retirement. Inflation is just one risk amongst many that are affecting retirees, as well as taxes. Two things that we know are likely going to be inevitable in retirement, are not necessarily going to go anywhere, but we don't know exactly what inflation or taxation will look like in retirement when it comes to the specifics. But planning ahead and having an understanding of how each of these accounts work is usually a good start. If you're looking to dive deeper or have a team help you navigate through this in retirement, check out HyperionFP.com, where my team and I help retirees stay retired and do so on terms that they can best enjoy the savings that they've earned. We cover things such as tax planning, investment planning, income planning. We also help retirees do their best to avoid taxes such as Medicare premium surcharges. If you're unfamiliar with them and you want to have a better understanding of how they work, be sure to check out this video right here.